Hey everybody, it's Brian Shannon from AlphaTrends.net, and today is the final day of 2016. Hopefully, it was a good year for you. Let's take a look at the numbers. These numbers actually on here don't represent the accurate numbers, so just keep in mind that, of course, the dividends aren't accounted for here, so the overall total return is going to be higher for the ones that pay dividends. But we did see the market finish out with nice gains for equities, take out the biotechs, and it was a real good year. Bonds seemed like they were down a lot more than 1.2%, but let's take a look at the charts. I don't have a grand scheme for next year. It's never my intention to try to make predictions for the year ahead. For me, as an intermediate term swing trader, my interest is what's going to happen over the next week or so, and how can I consistently pull money out of the market. Overall, we are in a bull market, of course, on this S&P 500. We're making higher highs and higher lows. If we look at the year-to-date volume-weighted average price, you can see we're well above that. We had seen that initially we gapped down and spent most of the time under it. Once that volume-weighted average price flattened out and we were making higher highs and higher lows above it, then we saw the Brexit scare come down to that level and then bounce sharply from the Brexit. We also saw that the volume weighted average price from the low was actually where we saw the absolute low of the election. So, these volume weighted average price levels are important. They will continue to be important. If we take a look at the volume weighted average price since the election rally, since the gap, we could look at it that way. And you can see that comes in just above that 50-day moving average, the 50-day moving average down here. But today we saw a little bit of a pullback, and that shouldn't have been a surprise because we were with a declining 5-day moving average. And we had seen this prior band of support broken and then acting as resistance the last couple days. So when we have a declining 5-day moving average, we're guilty till proven innocent on that intermediate term time frame, and that means you want to exhibit caution on your longs. Of course, if you're a very active day trader, there was a real nice rally here at the close, but that's not the way that most people trade, I don't think. So going into next year, what we're looking at is potential for resistance up at 225. If we can get back above that level and then maybe pull back and see the 5-day moving average flatten out, that's, just getting above it would turn me more neutral than cautious, and then more bullish if it was to hold up above that 5-day moving average. But right now, we're guilty till proven innocent under the declining 5-day moving average as we make lower highs and lower lows on the intermediate term time frame. The long-term time frame still in a major bull market. The Nasdaq also still in a major bull market. It's a little bit disturbing that the recent breakout failed here. We could take a look at that. This is the prior band of resistance, and we had finally, spent some time and then broke above it, earlier in the month. But today we, pulled the last 2 days, we've pulled back pretty deeply and right to the rising 50-day moving average. So I think that tells us that, we made a lower low here on the daily time frame, but we're above a rising 50-day moving average. I would expect us to start to stabilize in here. Expect us to stabilize doesn't mean I would buy it here until I actually saw evidence. And we're looking at a 30-minute time frame right now. This is a declining 5-day moving average. We've got this prior band of support that now is likely to become, or is certainly highly possible that that could become resistance on the intermediate term time frame, and then maybe it does something more along the lines of that. That's what would get me back to bullish on the Nasdaq from an intermediate term standpoint. But buying pullbacks, isn't my style. I don't like to buy as the market's pulling back. I want to buy it after the pullback and once it's started to stabilize and then make higher highs and higher lows. So it's not about hitting exact turning points. It's more about keeping a good risk reward ratio for the time frame that you engage the market. And I would suggest that If you're not familiar exactly with what your plan is for next year or just in general, that start focusing more on trading the market structure rather than listening to news. We saw, of course, that the Brexit news and then the election was just a bunch of noise realistically. But we'll keep an eye on this Nasdaq intermediate term trend, guilty till proven innocent. Longer term, still in a major uptrend, and we'll just continue to take it, day by day, week by week. The Russell 2000 had a super strong rally here after the election and has been holding on to most of those gains. If we take a look at the daily chart here, you can see the volume weighted average price year to date. We've been well above that for quite a while since the election. It's still significantly lower, but the thing of short-term concern is that we did break below this what's been a little bit of a band of support in here, and that would be, of course, near this 135 to 135 and a half. Now, we're only slightly below it, but we are below it, and we're below a declining 5-day moving average. So for us to get more neutral in the Russell 2000, I think we need to see it back above 136, and then to see it hold above there for continued upside in the Russell 2000. Now, the semiconductors had a really strong year, obviously. We spoke about those over and over again through the year as far as being one of the stronger groups, and they really made life difficult for the bears in here. We saw a couple of breaks below the 50-day moving average, but during all of these breaks, the direction of the 50-day moving average was still higher, which told us that we still wanted to give the benefit of the doubt to the buyers, and that short selling was only a very short-term player's game. There's always opportunities to make money on the short side, but when you have a rising 50-day moving average, that occurs because the price is moving higher, and mathematically, when we have higher highs and higher lows, there's simply more opportunity on the long side. The sum of the rallies, 2 plus 5 plus 7 or whatever, versus the sum of the 1 point, 2 point, 3 point pullbacks, the sum of the rallies is always going to be greater than the sum of the gains, giving us more opportunity on the upside, of course. The semiconductors right now have the potential for some support in this general area, 71.5. If they wanted to really sell these off, I think maybe another test of the 50-day moving average. But heading into 2016, we are below the declining 5-day moving average, and that tells me that we need to see it back above that 5-day moving average to become more neutral. What we might see happen is something like this. I'm not here to predict. I'm here to anticipate all the potential scenarios based on the time frame I'm comfortable trading and then managing risk. And I say it from my perspective because that's what I do. I'm certainly not here to tell anyone what to do. I'm here to help you see the levels and determine for yourself what you want to do with that information. The biotechs, as we know, they had a distributional year late 2015 and then entered their bear market as it started making lower highs and lower lows below the declining, with a declining 40-week or 200-day moving average. And as we say, if they don't scare you out on the way down, they'll typically wear you out. In order for the biotechs to longer term turn bullish, we need to see a higher high above a flat to rising 40-week or 200-day moving average, and perhaps it would set up something like that. But right now, we're still guilty till proven innocent. Looking at the daily chart, and we had looked a couple weeks ago for the potential of a turn up above that 275-ish level, but it never made it through there, and it never closed above that year-to-date volume-weighted average price on that attempt. So when we back it up a little bit, we did get above 275, and for the people who take those levels literally, meaning that you have to buy above 275, don't forget next year. I mean, I say this all the time to subscribers. It's on our sheet every single day. When you see a market that's so-called breaking out, ask where has it come from? It just rallied from 266 to 276, and where does it have the potential to go? So it was in this area of prior resistance, and it was extended. So instead of purchasing right there, because it's extended, you wait for a pullback to develop, and then if it were to occur like this, then buying the break here with a stop underneath a higher low would have been the trade. Instead, being on the sidelines in cash or fading it if that's your move would have been the right thing to do. But horrific year for the biotechs this year. I think it's interesting that Facebook closed pretty much right on its year-to-date volume-weighted average price. And if you're not familiar with volume-weighted average price, it's the average price of every single share that traded over the period of time you're examining. So for the average price that this stock that Facebook traded at this year is basically right where we closed at about 105.05, meaning the average participant basically wasted their time in there. Now, of course, there's tremendous opportunity for movement in there in both directions, but heading into next year, we are below a 200-day moving average, so this is looking a lot more distributional, and perhaps 2017 is going to maybe put a dent in this longer-term uptrend, or at least maybe come down and test this trend line. But I'm not going to talk about a lot of stocks here. I want to instead just wish everybody a happy new year. And I guess I didn't size my image properly here, but anyways, happy new year. Don't forget, only price pays, and hopefully you had a good year, and 2017 is better for all aspects of your life. Thanks for tuning in.